Good morning, good afternoon, and good evening for all of you who are in 3 different time zones in the world. It's a truly great pleasure and a great honor for me to introduce this panel on the role of governments and IFIs in mitigating risks and coordinating the policy response to climate change. We have an exceptional panel with us today. We have, let me introduce them in the order I see them. Maurice Obstfeld, who's Professor of Economics at UC Berkeley and a former Chief Economist of the IMF. José Antonio Ocampo, who is my colleague at Columbia University and a former Finance Minister of Colombia, among other many important other functions. Ceyla Pazarbasioglu, who just joined the IMF from the World Bank and has taken on a very important position as Director of the Strategy, Policy and Review Department. Posen, who's the President of the Peterson Institute for International Economics, and Marc Sadler, who manages the Climate Funds Management Unit at the World Bank. We will divide the panel into 2 general questions, and I will ask the panelists to speak in turn in response to each question. I will give about 5 minutes each for the first question, and then I'll turn to the second question and we'll do another round of 5 minutes each. This will take about an hour and will leave us about 15 minutes for Q&A at the end of the panel. So with that, let me ask Ceyla to begin with her remarks to the following question. So this is the first general question. Let me read it to you. One of my favorite quotes on climate change mitigation is by David Pitt Watson, the former co-chair of the UN Environment Programme on Finance Initiative. And he said, let me quote, "When it comes to climate change, we're all players, we're not spectators." The Green Swan report calls for cooperation and coordination among all government actors, financial institutions, corporations, multilateral development banks, and civil society in combating climate change. What is your perspective on how this could work? How can cooperation be enhanced? What are the potential pitfalls? Ceyla, I will hand the microphone over to you. Thank you.
Thank you, Patrick, and it's a pleasure to be part of this great panel. This is a very important and timely event, and the Green Swan report is excellent in terms of framing the discussion. As is mentioned, climate change mitigation is a global public good, and its sufficient provision requires effective coordination. And as you say, we are all players, and each entity here today has a very specific role to play. And time is of the essence. There's no time for complacency. When we discuss reaching net zero in 2050, it sounds like a long time away and that we have a lot of time to act, but in reality, we are already falling behind. I want to talk about 3 priority areas where cooperation is critical and needs to be enhanced. The first priority is to translate medium-term net zero commitments into specific short-term policy goals. This year's COP26 meeting provides an opportunity to align countries' interim emissions target for 2030 with net carbon neutrality by 2050, and the interim targets should be underpinned by specific mitigation measures such as path for carbon prices or equivalent regulatory action. And in this context, a very important priority, so the second priority in our view, is to increase carbon prices. And carbon prices at this point are far too low for meeting commitments under the Paris Agreement, let alone for limiting warming below 2 degrees Celsius. Realistically, global carbon prices need to rise steadily to about $75 per ton from about $2 per ton today. Unless we begin to meaningfully adjust now, emissions will not fall far enough or fast enough. So we have called for an agreement on an international carbon price floor among the largest emitters of global emitters of greenhouse gases. A minimum carbon price can be agreed among the 4 largest emitters. These are the EU, US, China, and India, and they cover more than half of global greenhouse gas emissions. And this would send a very powerful signal, especially to other countries that are considering carbon pricing. This would reduce concerns about carbon leakage and loss of competitiveness. An international carbon price floor could be phased in gradually, and equity concerns could be addressed by differentiating the price floor between advanced economies. They can be much more ambitious, and emerging market economies, possibly complemented by border carbon adjustments. And the third priority is the provision of climate finance. Advanced economies pledged $100 billion a year from 2020 onwards to transfer resources to developing economies to help them achieve their mitigation objectives. But today we are far from reaching that goal, and accessing whatever funds are available can be very cumbersome for vulnerable countries with limited capacity. So many climate vulnerable countries also need financing for adaptation and resilience building. This will require grant financing and lending at concessional terms and innovative instruments. This could be debt for climate swaps, contingent debt reduction, contingency funds, regional reinsurance, state contingent debt instruments, and catastrophe bonds. So we really need to work on these issues. The financial sector also needs to adjust to climate change to provide the necessary financing to protect, and also to protect financial stability. And the cooperation with regards to data, taxonomy, and regulation are really critical. So these are the top 3 priorities in our view, and we are at a critical juncture at this point, and really we need to call action from governments, IFIs, and the international community at large. Thank you.
Thank you, Ceyla. These are very important initiatives. I'm particularly excited about the debt for climate swaps, given how many poor countries are struggling today meeting their debt obligations, something I have been discussing in other settings with José Antonio Ocampo, but I don't want to steal his thunder, so I'll give the microphone over to you, José Antonio.
Well, thank you, Patrick, for inviting me to this interesting panel in this really great conference. So I'm very glad to be with all of you today. Let me actually start referring again to Ceyla's third point. The developed countries committed to finance, to increase financing for climate change mitigation and adaptation to $100 billion a year. This is a commitment adopted more than a decade ago, and they are far from that target. One area, however, in which I want to refer to, which there has been advance, is in the financing by multilateral development banks. To start with the European Investment Bank, which is really the leader in financing climate issues, but also all multilateral development banks supporting emerging and developing countries have been doing that. I would say under the leadership of the World Bank, but all the regional development banks are also on board. According to the data that is available, financing for emerging and developing countries from multilateral development banks increased from around $27 billion in 2011 to $40 billion in 2018-19. Last year, of course, there was a decrease, but still the data is not fully available. That is actually an important share of the financing by MDBs. Let me say that financing should not only be for mitigation, but also for adaptation. And I say this as a citizen of a tropical country, because the tropics will be hardly affected by climate change. And in that regard, it is also correct that the adaptation financing has been increasing a bit more than mitigation. But both have to continue to increase significantly for multilateral development banks. And the third point I want to make is in reference to the connection between multilateral and national development banks, which have to be to play also a very important role in financing, in sense leveraging also resources from private financing, the private financial system. And in that regard, I think there are probably, let me briefly measure four priorities. The first one is, of course, clean energy. Energy generation, energy transmission, energy efficiency in general. The second, and very important for Latin America, is stopping deforestation. So giving alternatives to, or encouraging actual reforestation and stopping deforestation altogether. I mentioned this because the main contribution of Latin America to climate change is actually deforestation. So that's a priority in my region. The third is actually promoting green bonds, which many national development banks have been doing in several countries. They have been actually, in my country, Colombia, quite successful in that regard. And last, but not least, let's say, also managing some of the climate risk, particularly these disasters that climate change may generate. Again, in the tropics, this is quite an important problem, and supporting the regions within countries that are affected by natural disasters associated with climate change is also an important priority. Okay, thank you.
Thank you, José Antonio, and also for staying within your 5 minutes. I will say a few words later on your last point, but I think also your reforestation, preventing deforestation, preserving biodiversity, that is a huge opportunity for some kind of funding that would help tropical countries and middle income and poor countries. Anyway, let me pass the microphone next to Adam. Adam, good.
Thank you very much, Patrick, and congratulations to Luis, the BIS leadership, the IMF leadership, the bank, the Banque de France, everyone who's been involved, European Central Bank, everyone who's been involved in this effort. I'm going to be a little bit of an annoyance because I'm going to suggest that this effort, unfortunately, is already reaching its limits. I don't mean climate change mitigation and response. I mean the effort of central banks and associated IFIs to lead the agenda on climate change. In the end, we need two things, as said very well by Ceyla and José, that we're not very good at, which is using the financial regulatory system to achieve real outcomes and getting international cooperation. And the last few years have taught us that that's not possible, or not so much as not possible, excuse me, I withdraw that comment, but it's much more difficult. And so what we've seen embodied in this Green Swan report is the ability of technocrats to say, no one else is doing this, let's try to do our best and let's try to set out a vision. And I commend everyone for doing that, given the emergencies as Ceyla put it out. But we also see that the price of fossil fuel companies has not gone to zero. We also see that the specificity of meeting these 2030, 2050 targets has not yet been generated. And we see a number of international tensions on the immediate horizon The US government, even under Biden's self-proclaimed leadership on climate change, has not yet produced a carbon price. And they're going to try to substitute subsidies for particular national industries as a substitute for carbon price, which leads to potential friction with the European Union. We see China making extreme pledges while continuing to invest in coal and dirty industries. We see the major developing countries, and let's point to the most politically important ones, Brazil and India, saying you are not doing enough to let us play catch up. Now, we all know this. So beyond being negative, let me say what I think we should do. The first point to the financial regulators and supervisors is to recognize that we now have an even greater imperative to extend the regulatory supervisory net beyond the core banking system. Because if we do not have the kind of leverage that we have over the banking system, then we will not be able to keep finance from getting to bad projects. So therefore, we need to extend to the non-bank financial intermediaries, the shadow banks, but also mainstream parts of the system like asset managers and insurance companies and pension funds, the demands and the same kind of scrutiny that we insist on putting on the others. The second point that I think we have to talk about is more intrusive surveillance on the climate front. The IMF and the World Bank have both spoken about this. There's some debate, is it really part of their mission? Should they be tacking this on? Should it be like the FSAPs, or is it more like Article 4s? The point is, whatever it is, we no longer can rely, as was seen in the public health crisis, on the statements of governments. So we need a commitment to a more intrusive climate supervisory process the way we have on banks. And that should be pushed for at the technocratic level. And third, I would emphasize that there needs to be a shift, and this picks up on some things José said as well as Ceyla, that a shift to recognizing the importance of public investment. Everyone is paying lip service to this, but we have not yet talked about separating green budgets, of making contributions to green technology and green investment and infrastructure, and the kinds of public good purchases in the developing world and the tropical world that José spoke about. And I think the fund and the bank can usefully, along with the central banks, start saying, this is not macroeconomically irresponsible. In fact, this is macroeconomically responsible. So those would be three realities, or at least I hope somewhat pragmatic, though ambitious things we need to do to get beyond simply central banks saying we wish finance would behave better.
Thank you, Adam. Absolutely. And I cannot agree more with your first point. And I wanted to just mention that it's interesting that one of the first initiatives of the Biden administration on the climate finance front is to work through FSOC, the Financial Stability Oversight Council, which I think goes to your point about including asset managers, insurance companies, and so on.
Thank you.
But let me give the microphone to Marc.
Thanks, Patrick, and thanks to all of the organisers for giving us at the World Bank the opportunity to speak today. I was really drawn to the quote that you used at the beginning, Patrick, and it made me think about this whole point about the different players. And the real point here, which is this has to be a team game. And quite often we're looking at the different players and we're looking at the tools in isolation. And the reality is you're not going to address the climate crisis in isolation. A regulator on their own is not going to do it. A government on their own is not going to do it. So that really comes to what is the role of the different players in winning the game. I think the first thing, however, and slightly contrarian, is to point out that for the world's poorest and most vulnerable, and not only are they really the spectators, they're the most disproportionately impacted by the climate crisis. I mean, they were not the players that created the situation that we're in today. And so, they're very clearly, the focus has to be on supporting them to adapt to the increasingly negative impacts of the crisis that we face. And secondly, to support them to develop the industries and economies of the future that will not put them in the position of becoming the emitters in the future. So there is a situation here where there are spectators and sort of innocent bystanders, and I think we need to be clear on that one. For the rest of the world, let's put it that way, I think it's really important to get away from this them and us dialogue, which often seems to be there. You know, as consumers, we bear the responsibility for the economies that produce the goods and services that we consume. And it's not that the government needs to do this or the government needs to do that. So consumers have a role to play in making better and more sustainable choices about what they consume, what they throw away, and what we waste. I mean, the examples through food, energy, water, clothing are numerous and almost never ending. Huge efficiency gains to be had, but much better choices to be made in what we actually consume. Companies have a role in better informing us about what we are consuming, where it came from, what was the cost of the goods that we're actually consuming, and then also taking a proactive role in reducing that negative impact that they're having on the global commons, if you like. And regulators, of course, have a role in enforcing the rules of the game and improve the choices and start to remove some of the bad ones. And the current governor of the Bank of England made an interesting comment the other day, who was pointing out that it's not really the regulators' role to step in and start making up all these rules. Their role here is to help enforcing them, but it needs to be driven by governments, of course, who have the role to incentivize the development of the new markets and products that are based on increased sustainability and reduce the negative environmental and social impacts of their economies and their consumptions. And of course, banks and financial institutions have a role in financing the new, better businesses and investing for the future and not in the industries of the past. So for all of this to come together, for the climate team to succeed and win the game, we need the markets, products, regulations, incentives, and finance that are really going to drive economic development of the future. And this all needs to be underpinned by increased transparency and information to enable consumers, companies, financiers, governments to make the right choices and support the right activities. Thanks, Patrick.
Thank you, Marc. I think you're raising a very important point in your comments. I always thought that there was too much emphasis on so-called direct emissions, scope 1 and scope 2, and not enough on indirect emissions, scope 3. And I think by emphasizing scope 3, we will bring in greater responsibility from the consumer and everyone down the supply chain. Anyway, our time is running slightly late, so I want to give the microphone and the screen to Maurice.
Okay, thank you, Patrick. I hope that worked. It's a pleasure to be here, and I want to thank the organizers for putting together a really fantastic and relevant program. I'd like to focus at a sort of more basic level, a more conceptual level in operationalizing some of the points that the previous speakers have made. And just to observe that, in line with what has been said about carbon pricing, a key tool in coordinating all the actors in society is obviously the price system. This is what economics has taught us since time immemorial. And a price on carbon emissions, in principle, can make actors internalize the impact of their emissions on others. Now, in the second part of this program, I will talk more about what others we're talking about. In principle, there are several ways to operationalize carbon pricing, a tax or trading permits. And it's important to note that it is not only taxes that are at issue, it is also subsidies, for example, for carbon absorbing cover crops. The price system is relatively efficient because in terms that financial regulators here at the BIS would appreciate, direct regulation doesn't get in all the cracks the way prices do. And a key element here is a concept known as the social cost of carbon. It is key for evaluating any green financial sector interventions. I want to talk a little bit about the recent history of this, particularly in the US. In the Obama administration, an interagency working group was set up to devise estimates of social costs of carbon, which were revised up until 2016. And these were supposed to be used in regulatory assessment and in cost-benefit analysis. The Trump administration disbanded the interagency working group in 2017, and it also revised the social cost of carbon estimate to a bare minimum. And this chart, I think, shows the departure of the Trump administration with its social cost of carbon, about $7 a metric ton, shown in brown. On Inauguration Day, the Biden administration issued Executive Order 13990, which reinstated the interagency working group. It requested interim estimates within a month and full estimates within a year. And in response, this working group gave interim values for 3 greenhouse gases, including carbon dioxide, just correcting the Obama-era methodology for inflation. So that's where the US is. And I just want to conclude this segment by pointing out that prices are essential for coordinating all of society's actors, but they're not enough. They don't solve all the problems we need to solve to get to net zero emissions. There are 3 problems at least. One is the general problem that R&D may be insufficient, especially green R&D, as a general matter, and need subsidization. The optimal IP framework for R&D, intellectual property protections, is an important question. It's analogous to the issue of vaccines that we've been grappling with in the pandemic. A second problem is network externalities. To really get where we want to be, we need a big push with government guiding the way. Just one example, electric vehicles need electric charging stations. If electric vehicles are run with coal-fired electricity, it's not going to be net positive. This is a big challenge, particularly for lower and middle income countries. Finally, imperfect capital markets bedevil the effectiveness of prices in getting to the optimal allocations. I'll stop there for now.
Thank you, Maurice. I couldn't agree more with your analogy with vaccines. I think this is an excellent way of thinking further on these issues. Let me now share my screen if I can. My presentation. I don't see the button here. No, my screen sharing button has disappeared. Okay, well, in the interest of time.
I still have it, Patrick, so someone should transfer it from me to you. I'm not sure if I'm supposed to do that.
Yeah, let me, in the interest of time, just say my remarks, or at least for the first segment. And I was going to start with borrowing a famous expression from a famous line from Hemingway, and diverting it for our purpose. And in answer to the question, how does change happen? I would use his words and say, gradually, then suddenly. And I think this is the moment we're in today. If we look at what happened in the last 10 days, we've had the publication of the IEA report on the net zero target, forecasting global demand for fossil fuels peaking this decade and calling for a halt to all new oil and gas exploration. We've had the ExxonMobil proxy contest unprecedented, where we go into the heart of Texas, in the heart of oil land, and we are seeing shareholders trying to change the business model. And then we have the court decision in the Netherlands on Shell. And I would argue that this is also playing a role in bringing about sudden change. And that the MGFS is actually a model of cooperation to emulate by others. Now, beyond that, my remarks were really to focus on two themes. And the first one being that combating climate change is really a war on two fronts. It's a war on two fronts because we need, on the one hand, to reduce carbon emissions to net zero by 2050. That means we will have to reduce, on average, every year, global emissions by the same amount as we did during the COVID lockdowns in 2020, which is a very important effort. And then the other front is that climate change is already with us. We see in some parts of the world, we've already reached a warming of beyond 2 degrees Celsius. And in 20% of the world, we've seen already warming 1.5 degrees Celsius. And then we see the size of the climate events getting bigger and bigger, and these are not insured. Just to give you one example, which I found particularly striking, and that is Honduras last fall. So the total estimated losses from the two hurricanes that hit Honduras, Eta and Iota, they were around 20% of Honduras' GDP. That's approximately $5 billion. And more on top of that, Honduras' GDP in 2020 contracted by around 9%. Now, what did we do to help Honduras out of this shock? Well, we did what we could in the current institutional environment. IMF gave an extension of its line of credit of about $250 million, and the World Bank extended financing to the tune of over $100 million. This is completely disproportionate. And so I want to, in my second part of the segment, I want to make a proposal on how we could better address ensuring climate disasters for poor countries. But let me stop this first segment and now bring you to my second question, which is more specific. And then we will do the same round, and again, 5 minutes each. So here's my second question. In your analysis, what concrete steps could be taken immediately by governments, IFIs, central banks, and the MGFS in mitigating climate change risks? And what channels of implementation do you envision, and what are the potential obstacles? And again, I will ask Ceyla to start the first round with this question.
Thanks, Patrick, and very important points were raised in the past few minutes. There are 3 key actions for governments. I want to first talk about what governments can do, and then what we are doing at the IMF. I mentioned already carbon pricing. This is, as Maurice said, it's not sufficient, but it is really necessary, and it's an indispensable policy tool for climate.
Ceyla, we have lost you. These things can happen. That's my role as a moderator to get our panel moving forward. Can I ask you, José Antonio, to speak next, and then I'll find a way of bringing Ceyla back.
In a world
It works.
Where there is less cooperation on SCC, BCA, the border cordon adjustments, will be needed more, but also they will be much more challenging to implement. Countries would have different estimates of the carbon embedded in goods. Convergence will also apply to ensuring that countries relying on different combinations of carbon pricing and regulations can agree on how to treat their equivalents. So this is really a very important point that was made. Second action that countries need to do, and was mentioned by José Antonio and others, is a green investment stimulus to boost the economy. And when this is combined with steadily rising carbon prices, investment in renewables and other low carbon sectors, as well as with transport infrastructure and services, this will really not only support the recovery from COVID-19, but also put the global economy on a low carbon path. And the third issue, of course, is just transition. Compensatory transfers to households and displaced employees is going to be really critical in order to be able to adapt these policies. Carbon taxes and lower fossil fuel subsidies could raise revenue for cash transfers to households affected by the transition to low carbon economy. What are we doing at the fund? I'm going to talk about 4 areas where we are active. First, we are adapting our policy advice, our surveillance work, and better integrating climate issues into our economic assessments. We are collaborating with other institutions, of course, the World Bank and others, to deliver the best policy advice to our member countries, as well as facilitate peer learning through good practice examples to integrate climate into macroeconomic analysis. So our surveillance role, which is the annual country economic assessment, Article 4 consultations, the health check, will systematically cover mitigation policies for the largest emitters of greenhouse gases. In countries especially vulnerable to climate change, we will focus on policies that support adaptation and help governments and businesses and communities build resilience. So to inform all this, we have been developing a new climate macro assessment program. We call it CMAP. This is tailored to climate vulnerable members in particular, builds on the lessons from our 6 pilot studies of climate change policy assessment, which we conducted jointly with the World Bank. We're also collaborating with the World Resources Institute and NDC partnership in order to get the CMAPs off the ground. And in our financial sector assessment programs, FSAPs, we are reflecting physical and transitional risks where they are material, and we are enhancing our climate-related stress testing capacity, improving our assessment of supervisory frameworks to account for climate risks where material, and supporting standardized disclosures that reflect these risks. So those are all the IMF instruments that we are really ramping up. Second, we are enhancing capacity development. This is really critical. We have developed tools to quantify carbon pricing and other policies for the Paris pledges and energy subsidies for 150 countries. As was noted earlier, we have estimated implicit global energy subsidies that are $5.2 trillion. They're 6.5% of global GDP in 2017. So this is very important to really address. In April, we launched the Climate Change Indicators Dashboard. It's an international data initiative that provides a one-stop shop for existing and new data necessary for integrating climate change into economic analysis. I've run out of time, but I'm going to mention one last thing, which is really important. We are exploring how we can support member countries using our existing lending facilities, as well as creating new ones. You may have heard about the new historic SDR allocation that's going to boost liquidity for all members if approved in June, and a voluntary rechanneling of SDRs by advanced economies or countries with strong external positions to support the most vulnerable member countries is under discussion. So we're looking at options, how these countries can channel SDRs, including a trust that could be used to fund climate-related financing. Thank you.
Thank you, Ceyla. I'm glad we got you back in time. I couldn't agree more with your point about fossil fuel subsidies. There was a story today that about COVID funding during the lockdown. there was unconditional funding to fossil fuel industry of over $180 billion. That's the sad reality. José Antonio, I don't want to take away too much of your time.
Well, thank you, Patrick. Let me actually refer to the network for greening the financial system, which you mentioned in your presentation. Let me say that this network was created in 2017, just after the Paris Agreement. It is chaired by the Bank of France, but with, as I learned, from a strong collaboration from the Bank of England and Bank of the Netherlands. I can proudly say that I negotiated the entrance of the central bank of my country, Colombia, Banco de la República, as a member, which we are the second Latin American member of the network. And let me say that mention 4 issues that are relevant in regard to what central banks can do together with regulators, which in some countries they are separate. Like in my country, the regulation is not done by the central bank. It is done by the government with the superintendency of the financial institutions. So, I must say they are also members of the network in the case of Colombia. So both the central bank and the superintendency are members of the network. Now, the first issue is the macro implications associated to climate change. And this is a particularly critical issue for countries that depend on fossil fuels of some sort for their exports or their economic activity, which is the case of Colombia. We actually had a very interesting exchange in a meeting with South Africa, which also has a similar problem. So how to, and this is, I think, a major issue that Ceyla and the IMF should take into account, which is the diversification of these economies. Because in the long term, we need to diversify. In the case of Colombia, it's actually possible because we used to be non-dependent on fossil fuel exports. So the possibility of encouraging other exports, manufacturing and agricultural, is particularly positive, let's say, actually under the current conjuncture, particularly for agricultural goods. The second is regulation, financial regulation. And in that regard, the critical issue is how financial institutions incorporate the risk associated to climate change in their balance sheets, as well as in the way they analyze financing. So in that regard, of course, the one regulation that should be implemented worldwide is the risk, the clear incorporation of the risk in the balance sheet of all financial institutions associated with climate change, including a stress test, which is, of course, a very important issue in this particular case. But that should incorporate, among other things, of course, the risk associated to asset prices, but also the risk associated to changes in regulation that may take place. For example, it is quite clear that if the carbon price is going to go up, which is a desirable situation, that will mean increasing risk for some firms, and this means not only financial firms, but let's say, for example, mining firms. Let's say those producing aluminum, which are very intensive in the use of energy. The transportation companies, et cetera, et cetera. So this risk should be incorporated into the analysis. The third is the incorporation of assets associated to let's say to environmentally sound firms in the portfolios of central banks. Now, that I think is an opportunity for developed country central banks. It's really not for emerging economy central banks, which have to, I would say, basically have a significant demand for foreign exchange reserves, as well as central bank bonds. Excuse me, government bonds, which means that the portfolios hardly get any sort of private bonds. But for developed countries, central bank, that is an opportunity. And last but not least, research on the policy implications and the financial implications of climate change. And this is, of course, a topic that has come up very clearly in the IMF research, which I welcome, as well as for example, the European Central Bank, which I also welcome. But we all central banks should do research. I'm only reason because the technical teams tend to be relatively sound in central banks, and it's an opportunity for governments also to enjoy the support of central bank research on this topic. Thank you.
Yeah, these are very excellent and important remarks, José Antonio. I'm conscious of time, and so I cut in. Sorry for that. Adam, what do you have to say to the second question?
I wasted seconds, sorry. The move to very practical things is, of course, the right thing to do, and I totally support what other speakers are saying about cutting subsidies for fossil fuels. That should be number one, and obviously aid from the bank and the fund to do that. The fund did some excellent work on this several years ago, and the scale of fossil fuel subsidies around the world is just horrifying and would be a major change. The second thing is that I think we need to look very hard at the reality of taxation, and the basic idea is everybody says carbon price, and all economists are simply enchanted with this idea, but in the end, taxes are enforced and can't be gotten around as easily and are more under direct control. So I would be crusading, and particularly the fund and the bank with the leverage they have, to get governments to substitute one-for-one increases in carbon taxation for other consumption taxes. And yes, this has distributional consequences and one has to deal with that. But in the end, if you're pushing to have indirect taxes anyway, let's increase the share of them that are carbon taxes and get that moving as quickly as possible. Third, as much as we talk about this from the financial institutions, I think in the end, the largest, most influential nation states and the largest emitters, as was previously discussed, have to play a key role. And in particular, I would want to call on the European Union, not so much the ECB, which of course is doing its best. But in the end, the European Union is the bloc that is significant and is furthest along in pricing carbon and furthest along in moving towards decarbonization. Obviously, many exceptions, the Polish backlash on coal being among them. And it is necessary for the EU to stand up to the US on its insufficient actions and use border adjustment to try to push the US in the right direction and set that for others. Finally, I would emphasize, as others have been doing, we have a transition macro problem of not just for developing countries, of what do you do with the people whose employment is being taken out of fossil fuels. And we've seen the years and years it's taken to get people out of coal in Europe, where they've been excessively generous. Not excessively, they've been extremely generous, and there's still resentment. And we've seen this in the US with the coal and the energy sector. And I think one has to switch from thinking in terms of generosity to force by state, that you start limiting people's options and telling them sticks as well as carrots, that if you choose to stay in this industry and stay in this region, you are costing people and costing future generations. And we're going to do more to move you out of these industries than we previously have done.
Thank you, Adam, and thank you for staying within the time limit. You asked all the hard questions, so with that, I'll let Marc maybe find some solutions to some of these hard questions.
Yeah, Adam's becoming a tough act to follow, asking all the relevant questions, but that's good. That's what we need to do to address the crisis we face. Look, I think the important thing here is that when we talk about climate risk, we have to be clear that we're talking about two things. So one is the risk to economies of climate impacts and how that's going to worsen over time. And the other one is the transition risk. I mean, where we're putting our money today, and will that be relevant money tomorrow? I mean, no one wants to be the person who invested in steam trains when electric trains were coming off the production lines, right? So there's two sides to this risk, and to be really clear that this is about people and animals and ecosystems, but climate change is an economic risk. I mean, I'm so glad in the past couple of years that has become a very, very clear mantra, whereas before it was an issue of sustainability. So that aside, I think on the developed country side, I mean, it's very interesting and great to hear this morning, actually at the specific conference, the FT already reported it, the comments of the governor of the French Central Bank with regards to disclosures and the potential for some of the major economies to turn up COP to put something on the table, and that the development of that and the agreement around that has gone much faster than anyone expected. So that's fantastic news. So then maybe to be a bit more parochial in terms of what the World Bank does and our clients, the absolute priority here is to put climate at the heart of development. Right? These are not two separate issues. They go together. And as others have mentioned already, under the first Climate Change Action Plan, we've gone a long way in seeking to achieve that. The new Climate Change Action Plan will take that the next step forwards. And in terms of nuts and bolts, we're now introducing these country climate and development reports, which becomes actually one of our fundamental economic reports that the bank uses and others use, for that matter, of course, in developing our strategic country diagnostics and our country partnership frameworks. So essentially, our dialogue with our clients about how we can help them and leverage ODA, but also climate finance to achieve their economic development, but in that climate context. So these are going to be rolled out this year. We think that that's going to have a fundamental impact in driving this dialogue forwards, not only institutionally, but with other IFIs, but also with our clients. This is taking the climate conversation right to the heart of the economic conversation. And that is, as we've already identified, a critical step. And then real nuts and bolts that flow from that, as we're highlighting in the new Climate Change Action Plan, and these sort of really focusing in on these major transitions that need to occur. So we've just been talking here about energy and the just transition, but that's why this becomes a whole of economy conversation. Yes, it's about payments and social safety networks, but equally it's about education. And how are you educating those people who will be losing those jobs, or people who were intending to have jobs in those high carbon industries? And where are we providing secondary and tertiary education for those current and future citizens? What are the jobs of the future? And what are the industries of the future? How are we investing in new green tech? How are we investing in new green economies? But then some of the other transitions, food systems, agriculture, land use. Very simply, if we continue to produce food as we always have done, by 2050, food systems would account for 70% of the 2-degree carbon budget. It would be the new big oil. So things have to change. We cannot keep going the way that we are. And as you touched on, Patrick, quite a lot of the emissions that we're seeing in terms of deforestation, land degradation in developing countries are there producing products that are consumed in developed countries. I mean, this gets to the tier 3 issue. So we're really focusing in on who pays for the totality of the cost of the goods. The cities and the urban infrastructure, I mean, this is really where, heart of economic development is being driven. And how do we do that in a low carbon resilient way and lock in the right choices and not the bad choices? Transport obviously is a huge part of this puzzle. It's been traditionally difficult to get at. And I think it was Adam, I can't quite remember, pointed out, you can have EVs, but if the electricity comes from a coal plant, that's not going to get you across the line, right? The ultimate impact is not what you're looking for. Sorry, Maurice, I think actually you raised that point. And finally, manufacturing, which has traditionally been a difficult piece to get at. So focus on these 5 transitions at the country level, at the heart of economics, a core of government approach. This is about economics, not just about sustainability.
Marc, thank you for these comments. You're absolutely right. We shouldn't close our eyes to the difficulty and the magnitude of the task ahead, and that we really need to roll up our sleeves and in so many different areas. Now, in the interest of time, let me pass the microphone to Marc and the screen.
Thank you, Patrick. And I feel bad about your being unable to share, but that won't stop me from sharing. I want to just very briefly, in the interest of time, make 3 basic points. First of all, I want to talk about the social cost of carbon as a global cost and what are some of the political economy implications of that. I want to talk about something Ceyla touched on, international coordination on measuring the SCC and the role of discount rates. And again, this is a topic that should be dear to central bankers. And finally, realistic pathways to control emissions and the implications for international trade. Now, the social cost of carbon as conceptualized by the US Obama administration, the Biden administration, and by other countries is a global cost. When it makes actors internalize costs, they're supposed to internalize global damages. But there is a tension because all governments operate under national mandates. And Ceyla can perhaps correct me on this, but even in IMF surveillance, there is a tension between what the IMF can ask governments to do in their own economic interest and in the global interest. Nordhaus pointed to this in a 2014 paper, has made this point a couple of times. One rationale is spillbacks. If other countries are damaged by our emissions, this spills back to us, but this is quantitatively insufficient. And in general, there are 3 arguments that have been made. The ethical case, which is obvious, the setting an example case, the leadership case, and finally, reciprocity, that we would like other countries to respond to our actions in kind, more or less the golden rule. And interestingly, there's some empirical work indicating that this is a real thing. For every ton of reduction the US pledged in the Paris Agreement, other countries pledged between 6 and 7 tons. Even when countries accept the global cost basis, their assessments, as Ceyla also pointed out, are likely to differ for various reasons, and this can cause some issues. In 2020, Canada's social cost of carbon was $38 per ton. Germany's in 2016 was $218 per ton. France and the UK use different approaches. Germany's methodology uses a declining discount rate, which is not uncontroversial. The US uses a flat 3% rate in line with guidance from the Office of Management and Budget, but all bets are that they are going to reduce this to 2% in line with the sharp decline in global real interest rates that has persisted over many years. We don't actually observe perpetual discount rates, which one would need for very long-term intergenerational costs and benefits. So there's also an ethical point about discounting. And some argue that we shouldn't use market rates at all, that the issue is really one of intergenerational equity. So national views may depend on national preferences and on demographics. Discount rates can differ across the world. I would suggest that governments need to get closer to the same page on all of this. One starting point for this might be a National Academy study that we in the Obama administration asked the National Academy to do in 2015. It came out in 2017, and it provides a template through which governments can periodically update the social cost of carbon and build transparency and also build buy-in from numerous stakeholders. There is actually a cost of carbon initiative between it's being run by Resources for the Future, which includes collaboration with my institution, UC Berkeley, on climate modeling. This already has international reach, but this sort of approach could foster international convergence on these estimates, which could actually be important not only for guiding policies, but also for building some sort of global consensus. Disagreements over the social cost of carbon could be disruptive. If countries have different methodologies for dealing with climate change, for example, quantitative versus price targets, this could lead to conflict in carbon border adjustment measures. We might think more about trying to mitigate these while also incentivizing countries to get more serious about climate change through climate clubs or critical mass agreements, as Bill Nordhaus suggested a couple of years ago. As far as climate taxes are concerned, Jim Stock has argued, and I think this is a persuasive argument, that politically feasible levels of carbon taxes simply are not going to do the job. It's not only the other externalities that I mentioned before, but just what is going to be politically possible. And what is likely to be most important is making zero emissions energy sources cheaper than fossil fuels. This will require an all-out global effort of R&D and of subsidies in these sectors to take account basically of learning by doing and complementarities that are going to be critical to exploit in the future. Again, this is not without perils in terms of trade. My Peterson colleague, Jeff Schott, had a very nice piece last week where he suggests modifying WTO rules to allow and exempt subsidies for clean infrastructure, so-called green box subsidies. Also, the WTO could go further in lowering trade barriers on environmental goods. All of this is going to be essential, in my view, to bring down the cost of alternative energies and bring us to zero emissions.
Thank you, Maurice. So I will close this round just trying very briefly to make one bold proposal that I think is within reach and that would add to all the other proposals that we've heard today in this panel. And remember what I said in my first round remarks, we're really fighting a war on two fronts. We really need to take that on board. And what I want to propose is that we need to be able to fight this war on two fronts. We need to create a new international agency, which in some work I've done, I'm referring to as the International Climate Agency. And the way you want to think about this agency is that it will play a dual role, a little bit like what the IMF, the role that IMF is playing. And the role is, one, it steps in when there is a climate crisis. It's the agency that will be called upon to help the Honduras of the world with, first aid, financial support, and rebuilding financing. That's the one front. The other front is helping countries through technical assistance, through monitoring and so on, in their path to net zero. And why a new, you might say, why a new agency? Why can't the IMF do this? Why can't the World Bank do this? Well, my thinking here is that in some ways, both the IMF and forgive me for saying this, given the members of this panel, both the IMF and the World Bank are fossilized agencies, and they have a particular mandate that they've inherited, and it's very hard to move away from that mandate to include climate change. So if you create a dedicated agency from scratch, you can move much faster. And the other point I want to make is that the IMF, the history of the IMF is a good example to follow. The IMF was not the institution it is today. It started out with a small group of countries. The countries, mostly the allies that won World War II. And they were willing to do this. They were bold. They wanted to move ahead. They wanted to face the challenge they faced at the time. And then the institution grew over time as other countries realized, yeah, it's in our interest to join. I think the International Climate Agency could play a similar role. Start with a small number of countries, small number of financial institutions, and you get them to start the institution, you get them to get the ball rolling, and you show to the rest of the world what can be gained by having such an institution that will really institutionalize the international cooperation we've been talking about here at this conference. So let me stop here. I see José Antonio is raising his hands. I'll give you a chance to quickly respond, but then I have 3 questions I want you to address from the audience.
Patrick, this is a United Nations issue. We had the Climate Change Convention in the United Nations. I speak as a former Undersecretary General of the United Nations because this issue we have discussed extensively. You don't need a new agency. You need either to reinforce the UNEP or reinforce the Secretariat of the Climate Change Convention, which is probably the best option.
I was perfectly aware I might get this kind of response. I think it's an open debate, let's put it this way. And anyway, I wanted to put the issue on the table, but let me turn to some of the questions from the audience. I got 3 questions, more or less, I think, on the same issue. It's a very interesting issue. So it's from Dirk Skolmacher, Fiona Stewart, and Caroline Gwenajin. And the questions have to do with how do we think about Article 4 and the expanding that to include climate monitoring of countries, and should we think, this was Fiona's question, should we think of extending the TCFD to countries and not just think of that for corporations and financial institutions? So I will let you try and grapple with these questions. Very concrete, very important set of issues. Maybe Ceyla, you're well positioned to be able to answer this question.
So I think it's a good idea because this, as we discussed before, there are many different partners that are stakeholders that needs to be taking action, and therefore enlarging this to a bigger group of stakeholders would be relevant and useful and increase coordination. So I think it's a good idea. I, like Jose Antonio, I will use the floor to also mention something about, I do think it focuses the mind to have a clear mandate. We actually discussed quite a bit at the fund whether we should have a climate department, but we decided against it because it cuts across all the work that we do. So that's something to think carefully. And also the costs of putting together an institution, I think, needs to be carefully assessed. But using the G20, G7, UN and existing setup and GFS, I think are really critical to make sure that what has been put on the table, and you heard across the different panelists, and now this question is a very good example, is actually to implement what has been put on the table. So I don't think it's an institutional issue. I think it's really a political commitment issue. Thanks.
Okay, anyone want to add anything to what Ceyla said? Maurice,
could I just make one comment? You know, I'm struck by in Ceyla's presentation by how far the fund has come in its attention to climate change and its work on the issue. You know, in late 2015, at the time of COP21, Madame Lagarde tried to get the executive board to endorse a statement on climate, and they refused. So she issued it under her own name. And when we in the research department started doing research on climate, of course, there had already been important work on fossil fuel subsidies and fiscal affairs, but we got a lot of blowback from member countries about why don't we stick to our knitting? And we argued that climate is macro relevant. So I think the events have proved us right, and it's great to see the fund getting so out in front on these issues.
Yeah, no, absolutely, Maurice and Ceyla, I hear that. I want to maybe play Adam's role here in response to your and also Jose Antonio's response. The Honduras example is particularly troubling, I think. $5 billion in damages versus maybe 300 million in aid, and some of this aid is in the form of loans. It's completely disproportionate. We don't have a system, an adequate system to ensure that different regions of the world, it's not just countries, it's regions, against climate disasters. The size of those financial shocks is beyond anything we see in the current architecture. So saying, well, yeah, but we can scale up the IMF, we can scale up the World Bank. I hear that, but I think politically it's going to be very hard to do because of the history of all the examples we have, IMF and World Bank. Every time they try to increase funding capacity, there was a lot of objection from various parts of the world. So this is I think this is the challenge. Marc, you want to chime in here? You'll have the last word.
Yeah, I think the important thing here is we need to do much better with what we've already got, Patrick. You can spend a heck of a lot. We don't have time. This crisis does not give us time. The speed of transition is just too quick. So start setting up new institutions. We could spend a lot of time. Maybe things would be better. We'd arrive too late. The second point then, which links with that, is we must do better with the financial resources that we have available today. Right? We have trillions of dollars sitting looking for homes to invest in, and we will always only be in the billions of dollars when it comes to ODA. And it comes down to this private capital mobilization. The history we've all been trying, it's difficult, it's hard. But what we're seeing, and I think what is a big game changer here is when we were doing private capital mobilization 4 or 5 years ago, there was a general interest from some. Now there's a very specific and direct interest that's coming from the financial sector about where can we place money and have positive climate impact and not end up putting our money into risky assets. That, I think, is where we must focus.
I'm afraid.
I just want to say I completely agree with Marc's 2 points, that there's an overflow of private money. We got to figure out how to mobilize it, and that institution building isn't the issue. It's about getting progress to the institution we have. And I agree with Ceyla, it's political at this point. And so.
Okay, Adam, thank you. I'm afraid our time is up. We're all frustrated on this issue. I think we would like to see much more capital deployed. I think we can agree on that. How we get there, I think that's actually quite a tricky question. But thank you all. This has been a fantastic panel, super interesting, and I'm sure many lessons will emerge from listening to the panel again when it is put out and being recorded. Thank you all.
Thank you.